Hi, my name is Dave Hardy, and I'm a certified financial planner candidate. That means I've completed the education requirement and passed the CFP exam, but I don't work in the industry. I'm just a hobbyist with a finance background. Oh, and that's Snoopy over there. Today, let's talk about bonds. Before I get going, I'd like to stress that everything I say here is for educational purposes and does not constitute financial advice, as I don't know your specific situation. So before acting on anything I get into, perform your own research and or speak with your financial advisor. Now, I imagine you're familiar with asset allocation, such as, in a broad context, putting a portion of your portfolio into stocks and a portion into bonds. That's one form of asset allocation. We normally think about that bond allocation comprising bond funds. Now, during normal times, from an interest rate perspective, when interest rates are not touching, say, 0%, bond funds or ETFs can be a reasonable counterweight to stocks, as they frequently increase in value when stocks go down. But like any asset class, bonds funds carry risk. Primarily that's interest rate risk and inflation risk. If the bond market is down and you need to sell your bonds to fund your retirement or make a purchase, you can lose money, or you will if the bond market is down. Individual bonds carry the same risk, but they also carry firm risk, the risk that the issue of the bond is unable to pay you back. You can eliminate that risk to the extent that any risk in the market can be eliminated by holding U.S. Treasuries, because the U.S. government can always print more money. So if individual bonds also carry interest rate risk and inflation risk, then how are they better than bond funds? That's because, at least for a certain period of time, that individual bond has a known set of cash flows and a known value at the end of the term. If I know I need $10,000 on January 1st, I'd prefer to purchase $10,000 worth of bonds with a maturity date of January 1st than to put the equivalent amount into a bond fund. Why? No matter what happens in the bond market, on January 1st, I get my $10,000 back. With a bond fund, I could wind up with more or less. Okay? So let's demystify individual bonds. Until I understood some of these basics, I didn't really trust myself to buy them. Okay, so first, I'll talk about why I like to buy individual bonds and for what types of scenarios. Next, we'll get into bond basics, such as face value, coupon rate, maturity date, yield to maturity, and price, and how some of these attributes move based on market conditions. Lastly, I'll walk through how to buy and sell individual bonds on a common discount broker platform. Now, I use Schwab. I'll be focused on simple U.S. Treasuries today. Okay, let's talk about why I like to buy individual bonds with a portion of my fixed income portfolio. First, let me say that I still have a good portion of my portfolio in bond index ETFs, and about a third of that is in individual bonds. And most of those are maturing in the next couple of years. Now, why would I do this? Well, a good chunk of this is non-retirement money. I've got a number of short-term or intermediate goals where I use bonds to save for them. So I also have a 6-month income replacement fund in my brokerage account, and that's over and above my the emergency fund for just cash for emergencies, which is sitting in savings. So short-term, I use bonds to save up for things like estimated tax payments to the IRS or property taxes, which are due in January. So as I set aside money for taxes, I just add to those bond holdings that have maturities around the time where I need to pay those taxes. I'm also saving up to buy a car in a couple of years, so I've been adding to a bond holding there that comes due late next year. And ideally, I've got enough to buy the car, or at least enough to put down a good-sized down payment. Now on the retirement side, I'm starting to build out my retirement income bond ladder. And I won't need that for a couple of years, a few years, let's see. But by the time I retire, my goal would be to have, say, 3 to 5 years of retirement income needs and a bond ladder to fund my retirement paycheck. If the market's down, I'm shielded from its fluctuations as I pay myself with maturing bonds. And when the market is up, I'll fill the ladder back up by purchasing more bonds. Let's get into the attributes of bonds. I'll focus on treasuries, which are those issued by the U.S. government. Treasuries generally have a face value of $1,000. They have a coupon rate, which is the percentage of that $1,000 that's paid in interest every year, typically in 2 payments. For example, a $1,000 treasury note with a 4% coupon rate will pay $40. per year in interest, and that'll be in 2 payments of $20 each. Now, a zero coupon treasury has no coupon payments. Now, a treasury also has a maturity date. That's when you get the $1,000 back. So, example, you purchase a $1,000 treasury note, which is due on December 30th next year. Let's say this one has a 4% coupon, and today is July 1st. Right? So on December 30th this year and June 30th next year, you get $20 coupon payments. Then on December 30th next year, you get another $20 and your $1,000 back. Right? So we had 3 payments of $20 or $60, and we got our $1,000 back. So the face value, the coupon rate, and the maturity date are fixed attributes for standard U.S. securities. Then how do bonds go up and down in value? And how does the market adjust? And how do we know that if the face value and the coupon rate haven't changed and can't change? Well, this is where we see the other 2 attributes of bonds. The price, which is different from the face value, and the yield to maturity, which is different from the coupon rate. Okay. So this is going to get a little bit more complicated. So let's say we want to purchase a bond, and today's interest rate is now 3%. So if I were to go purchase a new bond issue, it's issued with a 3% coupon. That's what would be available in the market, right? But what if I wanted to go buy that bond that has the 4% coupon payments on the secondary market? Somebody bought it last year. Anybody holding that bond is pretty happy because they're getting better than the market, and that bond has increased in value, right? Because interest rates go down, bond values go up. The face value is still $1,000, but the price is higher. I'd have to pay a premium to purchase that bond. So again, a new bond would pay me $30 a year in coupon payments, whereas that other bond would pay me $40 a year. So I need to pay for an extra $10 a year of coupon payments. Since we're talking about 3 payments in this scenario, instead of $10, we're talking about $15, a $15 premium for that 4% bond. That means the price would be around $1,015. Okay, so for that price, I would get 3 $20 coupon payments. And if I were to calculate it with a present value formula, I would see my yield to maturity is 3%. Okay? Now note that the inverse can also be true. If interest rates go up to 5%, that 4% bond loses some of its value. And there you'd have to purchase it at a discount in order to get a 5% yield to maturity. And that aligns, again, that would align with prevailing interest rates in the market. So with a discount, the price would be in the neighborhood of $985, right? A $15 discount for that 4% bond. So you can see that the price is impacted by the number of coupon payments, right? We had 3 payments, and we were looking at a $5 delta on each of the 3 payments. So the bond went up in value by about $15, or it went down in value by about $15 for a 1% change in the interest rate. But what happens if we have 5 payments or 30 payments? The further out the maturity date of the bond, the bigger the price swing. So one rule of thumb with bonds, and bond funds for that matter, is the longer the term of the bond, the more sensitive it is to interest rate changes. Okay. Now, let's go back to the zero coupon bonds. Can you see how we make our money there? Since there's 0 coupons, we'd have to deal with a premium or discount. So these are short-term issues of 1 year or less and simply sold at auction at a discount to the $1,000 face value. So a 1-year 0 coupon T-bill with yield to maturity of 3% would cost about $970. Let's walk through how to buy bonds on your discount broker platform. I'll show this with Schwab, and other platforms are similar. All right, so let's look at Schwab. Okay, so let's look at Schwab. I'm now signed into my Schwab account, and I'm going to focus on a couple of bonds in here. Right. So first, I've got a U.S. Treasury note. Let's just walk through how we can see the coupon rate, etc. Okay, so here's a U.S. Treasury note. It's 4%, so it's a 4% coupon. So for every $1,000, I'm going to get $20 in payments every 6 months. Okay, and this was due December 15th. So today is actually September 18th, so this is due in about 3 months. Now this one's kind of interesting in that the price is $100. Okay, now bonds are priced per $100. Okay, I know it's a $1,000 bond, but it's a convention. So you can kind of think of the price as a percentage of the face value. So this is the price. Basically, it's $1,000. If I were to buy one bond today of this today, it's $1,000. What does that tell me? It's the yield to maturity is 4%. So interest rates are 4% for stuff maturing in 3 months, because I'm not paying much of a premium, very, very, very little premium, which means that the yield to maturity is probably like 3.99, 3.97, something like that. Okay, so I've got $4,000 in this bond. So on December 15th, I will get $4,000 back. All right, it's also 4%. So 4%, that's $40 a year, or $20 per 6 months. Since I have 4 of them, I'm going to get $80 back as well. So I'll get $4,080 on December 15th. Right? And again, that tells me that interest rates are around 4% for stuff that's maturing in 3 months, because the coupon rate is the same as the yield to maturity, roughly. Right? So if I were to go sell this today, I'd get $4,000 back today, and some of the interest. Okay, I'll talk about that in a minute. Now let's look at another one. Here's one due also in December, is 12/31, but it's only worth $98.96. All right, I've got a good 1% discount on the price of this bond. Wow, what's the difference between this one and this one? It's my coupon rate. This one only gives me a 0.375% coupon rate, meaning $3.75 a year per $1,000, as opposed to $40. Right, so it's only getting 10% of the coupon of the yield there that we're getting. So it's going to be sold at a discount. So basically, I'm getting $1 off, right, or $10 per thousand. You know, $1 off per $100. So $10 per thousand. Since I've got 4 of those, it's a $40 discount. Right, so I can see the price, $39.58.44. If I sold it today, I would sell it at about a $40 discount to what I'll get in 3 months. Okay, 3 months I'll get the $40 plus $3.75 divided by 2 times 4, or about what, $7.50. I'll get $7.50 plus my $4,000 on December 31st, and so it's going to grow by about $40 in value between now and then. Okay, so both of these are yielding. Yield to maturity is about 4% between now and then. Okay, this was kind of interesting there. You know, same maturity date, but different value because the coupon payment is different. Right here, I'm going to get $40 in coupon payments, and here I'll get $7, or actually $80 in coupon payments because I have $4,000. And here I've got $4,000, so I'm getting $7.50 in coupon payments. So big difference there. Okay, now let's go buy a bond. All right. So we come up here to trade individual bonds, and the first thing I want to show you, and we're going to look at this row here, U.S. Treasuries, all right, and we'll see that in 3 months it's 3.97, right? Just like we saw, we have those bonds that mature in December, and they're almost sold at, you know, you can tell that it's at 4% because I've got a 4% one that was sold right on the money, very little discount or very little premium. So 3.97 is right there in the realm of possibility. Note that the yields are starting to go down as we go out into the future. Wow, you mean I get more money for tying it up for 3 months versus tying it up for a year? Why is that? People are expecting some interest rate cuts coming, right? And so we actually see a yield curve. This is called the yield curve. If you plotted this in a graph, it's actually going down, going down, going down, and doesn't start bouncing back up for about 4 years. So people are expecting, you know, maybe a little bit of deflation. I mean, a little bit of a recession. Maybe they just, you know, they think there are going to be some interest rate cuts, you know, over a while. And prevailing, they believe that inflation might be tamed a little bit. Interest rates are going to go down a little bit over a few years, eventually start going back up. And we normally expect 10-year bonds to be yielding a lot more than 1-year bonds. Okay, when they're yielding less, we call that the inverted yield curve, and that usually means people are forecasting a recession. Right? And you see these really long-term 30-year bonds, 4.71. Right? I wouldn't touch that with a 10-foot pole because if you get 5% inflation or something like that, you're going to lose your shirt on that stuff. Right? Anyway, let's look at purchasing a 1-year bond. But anyway, that's how you can kind of see the yield curve, just by looking at the prices of these bonds or the yield of maturity of these bonds. So we're going to go look at 3.7% yields. And this is kind of what it looks like in the platform. We'll see a lot of maturity dates. They're all over the map because what Schwab will do is pull up just kind of the best yields that you can get within the search time frame. All right, and if you don't see a maturity date exactly what you're looking for, you can go modify your search and pick 2 months, and then it'll just show by declining date, and then you can find the right date and then compare rates within that date. So the things to look at on this screen are you've got your maturity date, coupon payment. I don't care that much about the coupon payment myself. I'm not looking for certain elements of the coupon payment. I just look at the maturity date. Because whatever, I get coupon payments from all my bond holdings all the time, and they just kind of pile up. And as soon as I get some cash, I can decide do I want to put that in the stock market, do I want to add to another bond position. I don't really worry about what the coupon rate is. I just think about my yield to maturity, my face value, and my maturity date. Okay. So we're looking at various dates. And look, you got August 31st here, and we've got 3 different yield to maturity because different people are selling them. All right, so these are just the quotes that are out there in the market. But also look at the min. If I want to get 3.7%, I need to buy $400,000 worth of bonds. I don't have $400,000 to buy for this bond, right? So I go down and I'll look for the next one, right? And then it's, oh, here I can buy $1,000. And so if I buy one bond, $1,000 worth, I'll get a yield to maturity of 3.67%. Not quite as good as 3.7, but it's pretty good, right? The price is here, so paying a premium, so the coupon rate is going to be more than the 3.67% because I got to buy that extra premium, right? So it's 4.625%. Okay, so if I bought $1,000 worth of a bond, I'd get that. Let's just click on buy to see what the next screen looks like. So we've got a fixed income trade. It matures October 15th next year. It's paying 4.625%, and my yield to maturity is still the 3.6, which is here, 3.67%. Now, default, it says I want to buy $25,000 worth. I don't, so I'm going to say 1,000, which means that the price is 100.99, which means I'd be paying $1,009.92. So, all right, so let's click on that, review order. Yeah, here's my $1,009.92. That's what I'd be spending for this bond at the 100.992. Okay, but why am I out $1,029? Well, there's some accrued interest. Right, $19.84 of accrued interest. That's because this thing matures October 15th of 2026. So I've got 1 month. Today is September 18th. So in 1 month, I'll be getting a coupon payment. Right, but whoever's selling it to me, they want to get their interest for that they've been holding this bond since the last coupon payment, which was in April 15th. There was a coupon payment, and so they've been holding it for 5 months, and they expect to get their 4.625% of that for that 5 months. So that's the 1984. Okay, so I got to pay them their 1984. I'll get the remaining $23. I'll get the remaining $4 or so. But on October 15th this year, I will get a $23 coupon payment, right? But 19 I just paid to the other holder, and I'll get my $23. Okay, that's kind of how that works. You've got accrued interest. So if you sell it in between coupon payments, don't worry, you still get paid a portion of that coupon payment based on the portion of the 6 months you held the bond. All right, now that you're educated, do you think you'll dip your toes in the water with some individual bonds? Make sure you understand what you're doing and the risks associated with holding bonds or any type of investment, and talk with your financial professional before proceeding. Let me know how it goes in the comments. If you want to learn how to set up a bond ladder for your retirement paycheck, take a look at the companion video here. Or maybe it's here. I don't know. Thanks for watching.